Welcome to FRK311 Financial Instruments. The specific outcome for this lecture. You should be able to identify financial instruments. You should be able to classify these financial instruments correctly and measure these financial instruments as well as account for them. In order to achieve these specific outcomes, you should be able to explain and in practical situations interpret the technical terms and definitions of the standards. You should be able to account for the initial as well as the subsequent measurement of financial assets and financial liabilities. And you should also be able to identify, classify, and account for compound financial instruments in accordance with the standard. As we've mentioned, there are various standards present here. Firstly, IAS 32 is mainly about the presentation and the definitions. IFRS 9 is the financial instrument standards, which is a new standard. It will eventually replace IAS 39 in total. It also deals with more principles. IFRS 9 also deals with the classification, the recognition, and the measurement of financial instruments. IFRS 7, the disclosure, we will only touch on that in FRK 311. Now, what is a financial instrument? It is any contract that gives rise to both a financial asset of one entity and the financial liability or an equity instrument of another entity. What's a contract? That's an agreement between two or more parties with clear economic consequences. The parties have limited discretion to avoid contractual obligations, and usually it is enforceable through law. Now, what's a financial asset? Any asset that represents the following: cash, a contractual right to receive cash or another financial asset from another entity, or a contractual right to exchange financial assets or financial liabilities with another entity, but under conditions that are potentially favorable to our entity. And lastly, an equity instrument of another entity, in other words, shares that you hold in Sasol or one of those big companies, which is an investment in your books. Right. Physical assets such as PPE and inventories. Note, these are not financial assets because these assets do not represent contractual right to receive cash from another entity. Although they can make you cash or bring in cash when they are sold, they do not have a contractual right to receive cash in the future. Prepayments. This is not a financial asset because the prepayment represents the right to receive goods or services, not the right to receive cash. Please look at example 18.1 in your textbook for self-study. A financial liability. Any liability that is a contractual obligation to deliver cash to another entity, your loans and your creditors payable, or a contractual obligation to exchange financial asset or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. Liabilities that arise from statutory requirements are not financial liabilities since they are not contractual of nature. You have an obligation to pay tax. There is no contract to do that. Look at this. Example 18.2 in your textbook. An equity instrument. That is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. For example, ordinary shares or share options of another company. Now here we can apply the accounting equation E equals A minus L. Equity equals assets minus liabilities. Please look at example 18.3 for self-study. We are going to do example 1 in class. Fair value. The fair value is the amount which amount will be received in exchange for an asset or the selling of that asset, or the amount paid to settle or transfer a liability in an ordinary transaction between market participants at the measurement date. In other words, it is a transaction between knowledgeable, willing parties in an arm's length transaction, which is basically our old definition. Work through paragraph 18.5 of the GARP 2015 handbook. It is only about a page long, so please look at this topic. FRK311 will look at level 1 inputs mainly. In other words, those inputs that relate to quoted market prices for identical assets in an active market. Level 2 and level 3 inputs is not applicable for us. Now, in order to be able to classify our financial assets, we have to classify them into, first allocate them to business models. So the objective of the business model for managing a financial asset determines which categories are available for classification. This objective will be done by the key personnel of the company. Now we have to distinguish between 3 business models. Firstly, with the objective of holding financial assets to collect contractual cash flows. In other words, you hold a financial asset and you collect cash flows out of this asset as well as the capital in the end. The second one has got a slight difference. A business model with the objective of collecting contractual cash flows and selling the assets. So it is part of the model to sell these assets, and therefore we have to look at that separately. Other business models, the intention of selling the financial asset at a higher value at a later stage. In other words, you hold these assets with the intention of selling them or of increasing their value to make a profit out of them. Now, an entity may have more than one business model. A business model should be determined for a group of financial assets. So we cannot do it on we cannot determine it on an instrument by instrument basis. Although we can have different models where you will allocate certain financial instruments to a certain model and then other financial instruments to one of the other models, you have to do it on a group by group basis, allocating the same assets to the same type of business model. Thank you. See you in class.